Gold advances as US-Iran framework deal, weaker dollar support rebound.
Australian dollar US dollar price forecast holds near 0.790 with bullish pressure mounting.
Oil prices slide after US. Iran agree to interim peace deal. Scouring the Strait of Hormuz for mines could take weeks.
Markets cheer the US-Iran peace deal.
CAC 40 climbs higher on US-Iran. Peace deal, weak oil prices. India wholesale prices, inflation climbs to 9.68% amid higher fuel costs.
Bitcoin price forecast. BTC extends rebound as US and Iran reach framework deal to end the war.
Brent, lower prices with key supports. Societe Generale, the BOJ is about to hike, why the Japanese yen is still pinned near 160. Canadian dollar, range trading outlook, NBC. Energy shares fall as Iran deal lowers Hormuz disruption risk. ECB's Casimir stresses on front-loading interest rate hikes despite US-Iran peace deal.
Japanese yen. Short positioning elevated into BOJ hike, MUFG.
What now after the stellar SpaceX debut on Friday?
FTSE 100 pares. Early gains, mining stocks, stay firm.
All right. Yo, 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 yo. Hey there, boo-boo. Let's go. All righty. Happy Monday, by the way. You made it through another weekend. Market's been open now for, 12 hours. The world's been moving. I hope you're not just waking up and saying, hey, what are we doing this week? Yeah. Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, whether it's good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. By the way, I've been saying that a disclaimer for over 20 years, every single day. I think it's 22 years actually now. Yeah. Starting way back at FX Bootcamp. Remember that? So, good to have you here. Good morning. We got a lot of geopolitics, but we also have a lot of central bank meetings this week. Yeah. So we got plenty to do. My name is Wayne McDonald, and I will be your guide on this thing we call Forex, a nice little journey. I am your humble servant leader. So let me know how I can help, but we're going to use TradeRs to uncover what the institutional investors are doing and try to align our trading with them instead of fighting against them. Was that all right, RJ, huh? Be careful.
SNB to keep interest rates at 0% on June 18th. And for rest of year, Reuters poll.
So anyways, let me know how I can help. We're going to use TradeRs Analytics, obviously, and we're going to use Trader's Way, obviously. So all of this is, again, if you look at it, you're probably pretty good at technical analysis. You probably understand the fundamentals, but the markets are choppy. There's geopolitics. There's other things going on. There's long-term. There's short-term. You're like, what am I doing? What am I supposed to do? How am I supposed to get there and achieve my goals? Wayne, help me understand it all. And I think the secret sauce is actually figuring out what all the institutional investors are actually doing with their money, because they've already hired quantitative analysts. They've already hired market strategists. They've already hired economists. They have experienced trading teams and trading desks. They've already thought about all the things we need to think about, like yield curve and the likelihood the central bank's going to make a change in monetary policy. They looked at geopolitics. They've looked at the various markets. They have all the same data. It's complicated. But if you can figure out what their decision was with all this complicated data, then you have the same intelligence as they do. And you want to line up with the institutional investors, not trade against them. They're going to win. You know? They're just going to win. So you need to make sure you're choosing your battles wisely. So let's start with the sit rep report from Aiden.
Good morning, I'm Aiden from Tradars, and let's get you up to speed on this shifting market landscape. Today's session is showing a decisive risk-on sentiment, building upon a very strong weekly trend. While the monthly outlook remains generally positive, the current momentum is significantly more aggressive as safe haven demand dissipates following Middle East peace developments. This is being driven by a sharp drop in energy costs and a rise in the U.S. 10-year yield as capital rotates out of bonds and back into growth assets. 1. Oil prices have slid over 5% following a breakthrough peace deal between the U.S. and Iran, providing a massive boost to market sentiment. Gold and Bitcoin are both advancing as the dollar weakens and the immediate threat of war recedes. Meanwhile, wholesale inflation in India hit 9.68% due to previous fuel spikes, but the current drop in crude should help cool things down globally. Traders are now looking ahead to the Bank of Japan's interest rate decision, where a hike is widely anticipated. Biggest movers right now, WTI crude oil VIX and Brent crude oil are down, Nikkei 225 and high-yield bonds are up.
Wow, huh? Let's see, oil way down, VIX way down, junk bonds are up. Smells like risk on. Look at that VIX. Back down to 16. Hey, bro. Hey, bro. A week ago, that was back over 21. Wowzer. So that's great. Back over 7,500 on S&P 500. That's great. Bitcoin. Hey, bro. We were at $60 or 60,000. 66 now. Yeah, that smells like about 10% up over the last week. Yeah. Gold dropped all the way to 4K, which we had projected earlier. Earlier meaning 2 or 3 months ago. Then the psych level of 4K is held. And now that we're moving toward risk on sentiment, gold is back up. Okay, and up 2.5 today, which is a good day. It's still $1,000 cheaper than it was 6 months ago. But maybe a bottom is formed. That's when you'd probably, if you're thinking that way, then that's where you'd look at things like seasonality. And there we go. Look at that. We just dropped below $80 a barrel. When was the last time we had WTI below $80? I don't know. This is the first time in a very long time, huh? Funny thing is, if you look at the linear projection of what happened since we were at 110, Aiden was pointing this down to like $50. Not that it would go to $50. It's not a prediction, but in our energy complex radar, it was just like, hey, this is this is the rate and the projection of the rate of change, which anyway, so it's interesting. Back below 100, which is good, but on US dollar, I'd like to see this at 96, 95. Like, okay, it's down, but it's still not low. And a weak dollar is a good dollar. A weak dollar is a good US economy. A weak dollar is a good international economy. Yeah. So it's down, but still high. And same thing over here. But there may be a regime change of why people buy treasuries. So we'll have to pay attention over the next days and weeks as geopolitics settles down to see why, or try to figure out why treasury the treasury trading constituency is doing what it's doing. Yeah, figure out why. Can you imagine that? Let's do a quick headline radar.
SNB to keep interest rates at 0% on June 18th. And for rest of year, Reuters poll. What now after the stellar SpaceX debut on Friday?
Japanese yen. Short positioning elevated into BOJ hike, MUFG. FTSE 100 pares. Early gains, mining stocks, stay firm.
ECB's Casimir stresses on front-loading interest rate hikes despite US-Iran peace deal. Canadian dollar range trading outlook, NBC. Energy shares fall as Iran deal lowers Hormuz disruption risk. Gold advances as US-Iran framework deal, weaker dollar support rebound.
Australian dollar US dollar price forecast. Holds near 0.790 with bullish pressure mounting.
Oil prices slide after US. Iran agree to interim peace deal.
United States dollar. Policy divergence and risk sentiment. BNY.
Take a look at our risk radar. And boy, oh boy. Friday was great. Monday looks like could be even better. Look at this. In the last 7 days, VIX has dropped 17.5%. Oil's dropped 11%. Put call ratio. Look at that. NASI's up. Dow is up. Gold is up. DAX is up. Yeah, and yields are down. What else going on here? Bitcoin up 10% week over week. S&P 500 stabilizing. It's basically break even for the month. But you know it was down. Big monster day on Friday. So now we're basically flat for the week, flat for the month. But, you know, that dead cat bounced. Junk bonds are up. Investment grade bonds are up. Dollars weak. Nice. Nice. So what has changed? So I went through this manually. Stupid me. Aiden does it for us. Put call ratio down. Oil's down. VIX is down. Nikkei is up. NASDAQ is up. DAX is up. Gold is up. Dow is up. S&P 5 is up. Yields are down. It's good, man. This is good. Yeah, there's our history. Look how bad things were on the 5th. Okay. Now, 10 days later, we're happy again. Yep. We're happy again. Hey, everybody. Everything's been fixed. Uh-huh. Yeah, everything's fixed. Nothing to worry about, everybody. Hang on. I'm going to refresh my page. Hang on. That's not. Hang on. I got my drawing stuff. Move that over for later. Did that refresh? It did. Hang on. Aiden's messed something up. Hang on. Sorry. I'm just teaching the old dog some new tricks, and sometimes it's slow going. Giving feedback to Aiden. Cool. So, anyways, what do we got going? Bank of Japan interest rate decision coming up in 15 hours. Expected to hike. So we were way down here, 000, and then up a little, and then up a little more. A little bit of a surprise here. Sideways, 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 sideways. Boom! One more. Yep. Now, there's going to be a lot less pressure if we truly are at the end of the war with Iran, which I highly doubt. But if we were, let's talk about this. There's less need of the Bank of Japan to have a strong currency if oil prices are fair market values based on supply and demand kind of stuff, right? So if oil's trading at we'll call it $80 or $75 a barrel, the Bank of Japan doesn't really need to intervene, nor does it need to raise interest rates. Both those things increase the value of the currency so they can buy more oil, but if oil prices come down, okay, it changes things. There's a big difference between $75 a barrel and $110 a barrel. Yeah. So maybe they jack their interest rates up to 1, which is actually very high for the Bank of Japan over the decades that I've been trading. Okay. I know they have a bunch of debt and yada, 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 but it is what it is. Okay, what else we got going on? RBA is a big deal in 16 hours. Okay. Expected to hold. Cool. CPI, maybe. What's going on in Europe? Is it awesome? I don't know. Retail sales on Wednesday in the United States of America. And where is our U.S. interest rate? Maybe it's further out. Tuesday, Wednesday, there it is. Way too much data. Sorry, everybody. We have way too much data going on. What the fudge? Bum, 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 bum. Boom, 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 boom. Yeah, so we'll have to cut all that down to the one thing we care about. So yeah, we'll do you guys want to do a special event for that? You guys want to do a webinar around the Fed decision? Thursday, a lot of unemployment. We also have the Swiss National Bank and the Bank of England. Inflation out of Japan. Like, I need to go through and clean a lot of this up. I don't care about core. We don't have to clog our calendar. CPI, fresh food. Are you kidding me? I need to do this. Inflation rate? Yeah, we care about that. Trade balance? Yeah, we care about. Philly Fed subemployment? No. Employment sub? No. No. Yeah. Employment change? Well, we care more about the unemployment than the employment. See. Aussie jobs looking nice, but again, we care more about the unemployment rate than the actual number of jobs in our economic analysis. Because if Australia added 25,000 jobs versus the United States adding 25,000 jobs, well, the United States is 10 times bigger. So, anyways. I guess I could just do this now. U.S. interest rate projection. Do I care about that? I care about this. We don't need to put it on the spike radar. So I guess all he's saying is a summary of economic projections here. Okay, he's being too clever, so I have to teach him what matters. We're going to read the summary of economic projections. Again, if we do a special event, we can read the summary of economic projections, right? Yeah, H2O producer. Yeah, I know that. It just hasn't been a high enough priority for me to focus on that. You don't need, I mean, you already have your own charts and it's already told you the confluence exists. Yeah, but there's like some animation glitch in the internal charts which you don't actually need. So, it's just been a low priority. So again, Wednesday CPI year over year, that's important. Out of Great Britain, retail sales, the United States, housing starts, great. Retail sales core, don't need it for our analysis. Interest rate decision, interest rate projections, again, that's summary of economic projection stuff, which we will review, but doesn't need to be on the calendar. GDP out of NZ, that's great. Looks like a really good week. RBA, CPI. Wait, why do we have retail sales twice? Interesting. I think this is Wednesday, right? That's probably the wrong day. Import export data. Yeah, we need that. Industrial production. Yeah, we need that. Ah, come on, stupid son of a. I'm going to have to improve the interface here. Cool. Cool. So there's our little calendar. Pretty good week. I think we've been blessed. It's nicely organized now. Mm-hmm. Cool. Just kind of look at the dispersion. Lots of our assets improved a month ago. Everything was between +2 and -2. It was really a tight market. Now we're spreading and improving our skew. It looks like a quite normal distribution. The big move on oil down, right, is huge. But if you look at most things are in the middle. There's a bit of um, a skew to the right, which is risk on, which makes sense, right? There's so loading. Hang on. Let's move out here. Yeah, I was noticing copper, huh? Now, I thought copper has been up because of the shortage of sulfuric acid required to take ore into a product, but it's interesting that it jumped so much today. Is it going back to a risk on asset? I don't know. I would have thought copper prices would come down like oil came down. Just kind of look the pound yen up, pound CAD up, right? Euro CAD up. So you start to see things here like yen weak, pound strong, CAD weak. Now, CAD coming down with oil, I think makes sense, right? Aussie CAD up. I immediately start wondering about Kiwi CAD. What about the USD? Okay, so dollar versus Swiss franc, very negative. Kiwi versus Swiss franc, very negative. CAD versus yen, negative. CAD versus Swissy, negative. So all of this makes sense. Like if I were me, I'd probably start in here and maybe buy some pound and sell some CAD and some yen. Really? But then this is so I see Swissy strong. but I want yen to be weak. So really, this is just, hey, yen is weak, but CAD is even weaker. You're kidding me. Wowzer. Now you can organize your thoughts a little better. Okay, so if you're going to be trading Forex today, pound CAD long is your first trade. USD Swiss franc is your second trade. Pound yen, Euro CAD, Euro yen. Okay, it shows you by asset class and the magnitude and direction of these assets. So pound CAD is where you would start. Pound CAD has a better opportunity than Euro CAD. Okay, then you'd look at Aussie CAD. Cool, right? It's a nice way to display it, isn't it? I think I love it. We have more confidence in NASDAQ right now than the S&P 500. Purdy. Well, I don't think we need to cover seasonality today. And do we need to do the bond radar? Yeah, I guess so. Fed on hold. So hike being now priced out. Well, again, inflation's likely to fall because oil prices are no longer $100, it's $80, so 20% cheaper energy. The biggest contributor to CPI is energy. So, yeah, that changes things, and money has been moving around the bond market. You can see here money still coming out of the short end, but definitely going into the long end. This is radically different than 2 weeks ago, just crazy different. So people are locking in. And that actually might be a good thing. In the short run, why would you buy a treasury when you think the NASDAQ's going to jump another 10%? You see? So money out. Okay. Or you can get, 3.85 for 6 months. But if you figure we just had a change in monetary policy, maybe you picked up 5%. Remember, look, a month ago it was 5.09. Now it's less than 5, which means people locked in the 5%. So they're like, well, I can get 3.85. Oh, wait, that's for a 1 year. Sorry. For 1 year, or I can get 5 forever. Okay. And this is really important. I've covered it in great length, so I won't do it again today, but how this is important to like insurance companies that have to insure your house for 30 years, right? They have their costs for that. They have their risk models for that. And if they say, well, we need 5% to offset our risk, dude, they just did. They just offset the risk. There's a reason why we have these things. Okay, today is Monday, so it's a big deal that we look at the COT. So go ahead and eyeball it. Okay. Things have changed since this. I need to remind you, this is factual. Don't get frustrated with how the world works. Large institutional investors are required to report to the CFTC at the close of trading on Tuesday of last week. They report their large positions. For some reason, it takes the U.S. government all of Wednesday, all of Thursday, and all of Friday to then report it to us, because apparently they're doing it with paper and pen and slide rule and an abacus. You're like, wait, this isn't automated? How come it's not instant? Why can't they just report on the close of Friday and 8 seconds later it's reported to the public? Why do they need so much time to report back to us? Hey, man, I don't have answers for that. You're like, really? You don't have computers at the government? But anywho, I'll take my sarcasm and put it in the parking lot. This is the most recent data available, but it's Tuesday of last week. It doesn't reflect SpaceX. It doesn't reflect the straight up Hormuz. Yeah. But it is what it is. Back then, we were risk off on crypto. Now, of course, we know this because we've been watching crypto like hawks. And we have all the data on the planet. Like, there's just, you wake up in the morning and you sell crypto. Well, that changed. We may now actually be on a risk on regime. This is why we have all the data. You're probably already on this new world. Everything's changed since this. Okay? You probably are crushing it in the crypto. Traders reports that. This is just the Commodity Futures Trading Commission. Good enough for government work. But here's the one thing that you should know. This is the long-term positioning. Like, for example, institutional investors are long the Aussie dollar. And they've been short NASDAQ. They've been short down. They've been short Nikkei. Why? Well, it's very seasonal. A lot of it, I believe, is profit-taking because, oh my God, the technical top for NASDAQ was so unbelievably perfect that we had that price for the NASDAQ in November. Think of that. In November, we had a quote-unquote prediction, if you will, for the top of the NASDAQ. Not the top of the year, but there's often two tops of the year. Okay, you should also know that. It's all seasonal. But in this case, we plotted out in November and December and January, like we had this fixed number, very, very specific number. We hit it, and it dropped like a ton of bricks instantly. Like, it was so satisfying because it's amazing to be able to read the market. Remember, it's not our opinion. It's the mathematical equation that we use, in this case, for implied volatility for the NASDAQ. And then we overlap that with some seasonality to try to get a shape. And which just means, well, we have a math. Are we using the right math? Well, for it to actually work, all the other institutional investors have to be doing the same math. And what it confirms is we are using the right math. So we know what the institutional investors know as well, which increases our probability of understanding their strategy, which means if we line our strategy with their strategy, they're going to carry us. You're the surfer, they're the wave. A wave of money that you're riding in the sunshine of wealth. That was actually beautiful. I might actually have a tear in my eye. Cool, man. Cool beans. Okay, so they at that time were net short, but not by much. But check this out. On Tuesday of last week, they did know things like a higher probability that the Fed doesn't hike, a higher probability of resolution with Iran, a higher probability of the market reacting positive for SpaceX. They knew that, right? And so they were actually buying. Even though they were net short, they were big buyers that particular week. So it's short term versus long term. So they had been bearish, but that as of Tuesday, they were already buying. Now, this is important, everybody, so listen up. They were already in their positions on Tuesday because this was reported. So Tuesday or sooner, they changed their behavior because of their future assumptions. And I just listed the obvious ones. So they're like, oh my God, something's changed. Everybody go long NASDAQ, right? This is the institutions talking. Everybody go long Dow. Everybody go long crypto. Even though for weeks and 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 weeks, institutional investors hated crypto. Boom! Last week they were going long hard. Oh my God, is Bitcoin up 10%? Yeah, we can spot the wave further out to sea than all retail investors. Retail traders can't see the waves coming. They just float out there and randomly grab whatever wave. We can see the wave coming days in advance. So we can look at crypto and Bitcoin, yep, but Litecoin, ADA for sure. Ripple, no. So either we didn't get the right data or for some reason Ripple's overvalued. People don't like Ripple. People were taking profit on Ripple. I'm like, really? Okay. Ethereum, really? So these ones were favorable. That's interesting. Why? I don't know why she swallowed a fly. Okay. Now, Nikkei, I think institutional investors are worried about the high oil prices. Remember, this is Tuesday of last week. And USD yen being at 160. Intervention, heightened intervention awareness, huh? Short squeeze on NASDAQ, short squeeze on Dow, short squeeze on S&P 500. See, the market's short, but boom! Not only are they going long, but they may be knocking out the shorts. Right? Who knows? But nice. This is good money. That's real money, y'all. That's what I like about this. This is real money. Hmm? Okay. Commodities. People weren't sure. Still long gold. Okay. Tuesday of last week, they were not longing yet, but it'll be interesting if this starts turning green, 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 green. Let's say gold. Gold goes from flat but long. So think of it this way. The price of gold was falling. So around this time, we were closer to 4,000. we're at 4,300 or, so back then we were closer to 4,000 and institutional investors were not selling. Okay. That's basically flat, right? Not even down 1%. And look how long. Okay. This is gold in the vault. There's way significantly more bulls than bears. The institutional market is heavy long gold. Gold's coming down and they're not selling. We can see the facts. So this is how you read it. What if institutional investors start buying gold again? We'll be able to see it here. Boom, 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 boom. Because if this rises, this rises. And likely the price is rising too. So then what happens is institutions start wiping out the retail bears. Then the retail bears flip because they're losing money selling. So even though they've been making money selling, now they're losing money selling. So they go back to basically break even and then switch teams and they start buying gold. But now they're buying gold along with institutional investors. Do we get back to 5,000 and beyond? Are we on our way to 7,500? Well, those are the good questions. Then you say, well, if we are, is it all geopolitics? Or is any of it seasonal? Or what happens if it is geopolitics now, but seasonal later? So now you go to your seasonality and you start planning the future weeks, months, and quarters in advance to the typical shape of the gold market. Yeah, we can do that. So now you see TradeRs is more than just price, it's time. Price and time. Are they long? Are they going longer? And when does it usually go long? When is it usually longest? Long, longer, longest. If you got those lined up, why not? Why not go to all-time highs? Why not? Okay. Cool. And you've already seen this. Yeah. We looked at it somewhere. On the other Forex, what are we doing? So I remember this too. Remember how strong it was? And then I'm like, no, but I'm not actually a bull. But you can see why it was strong. Institutional investors were buying it. And I'm like, I'm not a bull. I don't think it should be strong. My economic analysis says it shouldn't be strong, but it is strong. And on the long run, institutional investors agree with me. They're also short. Cool. But that particular week it was long. I can see why. For some reason, they decided to buy it. What was the reason? I don't know. You can start doing your research. Is it a change in monetary policy? You can get that from our rates radar. Is it seasonal? You can get that from our seasonality radar. Is it sentiment? I don't know. You can get that from our headline radar. Does the Bank of Japan hiking mean more money into Japan? Well, Japan, I've always taught people, in my mind, is a de facto reserve currency. So if you asked me, hey, Wayne, I would answer, well, we have the US dollar is the reserve currency, but the Swiss franc and Japanese yen are de facto traditional reserve currencies. A stronger yen entices domestic Japanese investors to have less money invested overseas and more incentive to have it invested at home. Now, it's not dramatic. Okay. So, will it radically? I don't know if it'll radically change the value of the yen. Also, I believe if oil prices do come down, and they're down now, but let's say stay down, would the Bank of Japan want more hikes? And I'm doubtful on that. So we could use the Japanese, the JGB market, the Japanese government bond market, to analyze the shape of their yield curve. And I would imagine over time, with the continued ceasefire and resolution with oil costs, that we would price out any pricing in of future interest rate hikes by the Bank of Japan, which then would be, well, essentially a good thing, right? Japanese companies become more profitable. So there's some fluidity here between the supply and the demand for the currency. So it's not always as easy as saying rates up, currency up. Yeah, maybe. But it really depends on the bets that have already been made. And that's what I'm trying to teach Matai, where those bets may have already been made that in 6 months, the Bank of Japan's at 1.25, and 12 months, we're at 1.5. Okay, let's say those bets have already been made. I've shown you that institutional investors think that far ahead. They're in the trade before the stuff happens because they've spent all this time and money on resources to be able to make decisions based on probabilities, not guesswork. Even though it's still guesswork, but educated guesswork. Cool. So what if things change and it's not that the Bank of Japan raises interest rates to 1.0, but what if the yield 1 year from after hiking interest rates to 1% then changes, and if you reverse engineer the math, it changes that we are no more likely to be a 1.5 based on the trades and investments that institutional investors actually make in the JGB market, and it comes down to 1.25 or even 1 being the implied future interest rate. Well, that is actually a cut, not a hike. And that's the big giant leap between retail and institutional. Retail is just like what's happening today, fellas. What are we doing in New York? Where you might be wanting to watch the 1 year Japanese government bond yield change. And you notice that it is indicating no more hikes at the Bank of Japan. And that changes everything. Yeah, we can do all that. Cool beans, huh? So you risk off, fellas, and very risk off. I'm not sure what you're thinking. Yeah. You need traders, and you need to go into the risk radar, because we do, I don't know, a couple of hundred calculations, and we just know it's not risk off. So if you're guessing risk off, and you're not instead actually reading the market, but you're guessing, I think you could do better. Yeah. Hey, by the way, I hope this week I'll be able to launch our rewards program. Good morning, Wayne. 4-day streak, 156 points earned. I'm going to hopefully be able to launch this for you and show you how you can drop your monthly fee for all the premium products at TradeRs. Most of you guys are in the upgraded versions. Cool. We should be able to, like, let's say, okay, you do 3 trades a day, you do mini lots, and what do you do? 2 mini lots or 1 mini lot? Okay. You will drop your cost by 85%. What do you think of that? 85% of your premium subscription will be paid for through your trading.
Spike alert, 90 seconds until United States NY Empire State Manufacturing Index is released.
You will also get a cash rebate from your spread. You will also get an equity boost to lower your leverage costs. Yeah. So, and a whole bunch of more stuff I don't want to talk about right now. But imagine that. So in that case, Jim, your monthly would drop from $200 to $29. Yeah. Wait, what? And your spread rebate would be more than the $29. So at the end of the day, everything would be free. And automated, right? That's the big thing. Everything automated. Yeah, I think your cash rebate would be over 29, right? From the spreads. So that offsets the $29. So Aussie's strong right now. We haven't even got to this section yet, but the news came out. Thank you for the spike alert, Aiden. Yeah. Euro strong right now. Yeah, Aussie strong. Kiwi lagging, which I prefer. Dollar weak, CAD weak, yen weak. This is everything that we've been asking for. So beautiful. Now, I'm not sure what bureau that's supposed to come from. So we'll have to check out the lag on that. That's not us, it's them. Oops. We can go here.
United States dollar. Policy divergence and risk sentiment. BNY.
SNB to keep interest rates at 0% on June 18th. And for rest of year, Reuters poll. What now after the stellar SpaceX debut on Friday?
Japanese yen. Short positioning elevated into BOJ hike. MUFG. FTSE 100 pares. Early gains. Mining stocks. Stay firm.
ECB's Casimir stresses on front-loading interest rate hikes despite US-Iran peace deal. Canadian dollar range trading outlook. NBC. Energy shares fall as Iran deal lowers Hormuz disruption risk. Gold advances as US-Iran framework deal. Weaker dollar support rebound.
Spike alert,
Australian
90
dollar
seconds
US
until
dollar
United
price
States NY
forecast.
Empire State
Holds
Manufacturing
near
Index is released.
0.7090 with bullish pressure mounting.
U.S. June Empire Fed plunge 5.7 versus plunge 14.0 expected. Canada April manufacturing sales plunge 4.2% versus plunge 4.5% expected.
Canada wholesale sales, MOM above expectations, 0% in April. Actual 0 point Fed.
United States NY Empire State Manufacturing Index below expectations on 14 in June. Actual 5.7.
Swiss consumer confidence weakens in May.
The U.S. dollar is lower to start the new week as Iran deal dominates and leads the markets.
Silver rallies as U.S. dollar slips on U.S.-Iran framework. Fed decision looms.
Iran's Baghay, sovereignty and territorial integrity of Lebanon, part of agreement with U.S. Canada housing starts SA year over year came in at 261.4K,
Lots
above
of news.
forecasts 255.1K in May.
Brent. Prices retreat toward $80 on supply optimism.
Yeah. I
MUFG.
want to go over to the spike radar here. No. All right.
U.S. June Empire Fed plunge 5.7 versus.
Stop it. And we had requests for the headlines to be clickable so you could actually read the full article. I don't like that idea because you don't need to read someone else's opinion on what they think about the June Fed, the Empire New York Empire Index, right? I don't like you reading other people's opinion. I like your opinion. But it was requested, and when you click on it, it now opens the article that, okay, so Aiden only reads this because I don't want him to know anybody else's opinion. Okay, but there you go. This is the actual article.
United States NY Empire. United States NY Empire State Manufacturing Index, actual 16.0, beat forecast.
Mm-hmm. Mm-hmm. Yeah, so definitely interesting stuff out there. Again, weak US dollar is a good thing. Platinum up, silver up, NASI up, S&P 500 up, Australian Stock Exchange up, German Stock Exchange up, oil down, Brent down, wheat down, gas down, corn down, soybeans
United States
down.
NY Empire State Manufacturing Index, actual 5.7, missed forecast.
Cool. So, anyways, let's come back. What else going on? The COT. Mm, 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 mm. Do, 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 do. I don't know if we have the JGB, so if not, we'll try to get them. Oh yeah. All right. Uh, hike, right? So where are we now? We're at 0.73 or 0.75. 94.8% chance that we have a hike June 14th. Now, but today's 15th, isn't it? Yeah. Not sure why he's reporting it on the 14th. I'll ask him. Okay. Now remember, we're reading the yield curve of Japanese government bonds. Okay, so yeah. So we're reading and we see a hike. There's the June 15th hike. Not sure why that says June 14th there. I guess the day before. I don't know. Anyways, so we have a hike. And that gets us to 1%. Some people think they may not hike, but it's only, if I can read that, 5.2% of the market thinks pause. 94.8 says hike. So therefore, it's not precisely 100, 1%, but the math suggests very, very likely. Then what? This is what we were talking about. The difference between institutional and retail is retail guesses. And I should be fair because I hear institutional investors all the time on TV talking about they think the Bank of Japan will do this. They think the Bank of Japan will do that. They think the Bank of Japan should do this. They think the Bank of Japan should do that. And then you realize they're guessing. They're guessing. They don't say things like, well, according to our research in the Japanese government bond market, we see X number or whatever likelihood of a hike or no hike. So we are actually now crazy smart. Oh, did he, Jim? See, I didn't do that. Interesting. Because I was watching over the weekend. So anyways, let's go back. Hike. Then what? No hike. No hike, no hike, no hike. And by the end of the year, yeah, a decent chance of a hike. December right now is pricing in a hike. So you hear guesses, even by institutional investors, guesses on TV, and experts and YouTubers. They don't even need to have an education to get on YouTube. So we have facts here saying, well, right now there's a 53.6% chance of a hike this December by the Bank of Japan. Until then, we're going to go to 1% and hold and see what happens in the next 6 months and adjust accordingly. And if oil prices are still low at the end of the year, there's no need for a rate hike in December. So we have our eyes on that 53.6% chance actually falling and a higher percentage likelihood of no hikes after this one. Now, what does that mean? Well, also, that means if this is priced in and if oil prices do stay down and there's less need for the Bank of Japan to raise interest rates at the end of the year, this will actually be priced out. So this isn't just like a cool party trick to give out some stupid probability number of a hike, no hike. You're like, well, Wayne, who cares? And well, what happens is because this is a vote with money, then money has gone in and been placed with the understanding or belief that they will raise interest rates today and again by the end of the year. If that changes because the global market conditions have changed, global risk has changed, just something has changed, then they have to dump those positions and unwind them. And that changes the value. All of a sudden, you might see moves in the yen that you were not expecting. And you're like, but why? Because it's not that it's not that they're raising interest rates. It's that people thought they were going to raise interest rates. Now they don't think they're going to raise interest rates and they have to sell their long positions or something, right? You see what I mean? So they have to unwind, and that's the secret sauce where a lot of people will say, well, I would expect the yen to do this, but something weird is happening. Well, the weird thing is The institutional investors placed their bets a year ago, and now they're going to unwind those bets because things have changed over the course of a year. This might just be saying, well, based on rates being at that level due to the Strait of Hormuz and high oil prices, right? So they're like, well, to hedge our risk, we're going to buy that JGB. If that risk goes away, then they can sell that JGB. And that is what matters most. Cool, right? And you have this level of intelligence for every major central bank in the world, including Norway. Yeah, that's amazing, right? Yeah. Hang on. I want to give them this. All right. All right. All right. All right. All right. All right. I'm getting hungry, y'all. All right. Do you guys want to do some charts? I know you like this page because I love it. Look how hot crypto is right now, bro. Bro, look at crypto. Remember how this took you a long time? You had to go like, well, I wonder what's going on in crypto now. I got to look at 7 different crypto charts. And you're like, well, is it just the 15-minute chart? What does the 4-hour look like? What does this look like? What does that look like? Blah, 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 blah. That would take you 20 minutes, half an hour of your time. I've reduced this down to 1 second. But not only can you do that in 1 second, then you can look at all constituencies, Asian equity traders, metal traders, right? US stock traders. We can do a risk analysis looking at the real time correlation of assets relative to volatility. What's Europe up to? What about bond traders? What about energy traders? Like, all of this you can get in 1 or 2 seconds of just there it is. Or you can say, okay, well, we're looking at all Aussie pairs, all Euro pairs, all Swissy pairs, all Kiwi pairs, all pound pairs, all dollar pairs, all yen pairs, all CAD pairs. So now that's 1, 2, 3, 4, 5, 6, 7, 8 times 15. And then you're like, but those are all on shorter time frames. What's happening on longer time frames? And you click that. And once again, it's 1, 2, 3, 4, 5, 6, 7, 8 times 15. What about even longer term? 8 times 15. Dude. And you can do this now in 3 seconds. right? So you have to go 8 times 15 times 3, 360. You can analyze 360 charts in just on Forex and get the precise data in seconds. 360 charts in a second, or 2 or 3. Holy smokes. Holy smokes, guys. And I know if you went through 360 charts, like let's say you went through these 120 charts right here for position trades, you're not going to say, oh, well, the dollar is strong over the last 30 days by 1.502%. Okay. And now what we're trying to decide, and this is the challenge with all trading and investing, all traders, all professional traders, we all have the same challenge that you have. Today versus the long run. And economics. We deal with long run and short run aggregate supply and aggregate demand. They're two different calculations. Long run versus short run. Everybody's got the same challenge. And so I think it was on Thursday in our afternoon webinar that we do inside of TradeRs for premium subscribers, people are asking about how to do swing trades in a situation where even swing trades seem to be adjusting pretty quickly. And I'm like, well, everyone's facing this same challenge. Doesn't matter if you have $500 in your account or $5 billion in your account. This is actually occurring, and it's very challenging. And it shows that the markets are moving sideways. And our risk has been telling us for weeks now, mediocrity. You need to adjust. Right? For weeks, these were flipping back and forth, even on the swing point of view. But when we went to the risk radar, for weeks, we were like, long term, 5 or 4, short term, 1 or 2. You know, so what does that tell you? Nothing's happening. And so when nothing's happening, what happens here when you go to swing trade? They flip because they're only kind of strong or kind of weak. Dude, based over the last 7 days, Kiwi is 0.5. That's not very strong. So it could flip back and forth because anything could suddenly be, it could drop to 0.4 and be here. Now you're like, well, I don't want to own this for 7 days. No. You're missing a couple of things. One of them is you have to put everything in context. Something is slightly strong for the week or slightly weak over the last 7 days. But in general, when you look at volatility and oil and the put call ratio in the options market and the NASDAQ and the Dow Jones for stock traders, when you look at gold and the DAX out in Germany, and you're looking at the 10-year yield and the 210 spread and the 2-year, which we need because we're doing the 210 spread. So now we're looking at the yields, but the shape of the yield curve and what that means. We're looking at the Nikkei. We're looking at the S&P 500. We're looking at Bitcoin. We're looking at junk bonds. We're looking at investor grade bonds. We're looking at dollar, and we're doing it on 3 time frames, and everything is weighted for importance, but also over time frame. And what does it say? There's no trend. That's what we've been seeing. And so we had this big, long discussion of, hey, when we're here on technicals and I click on swing trade, it's very difficult to trade because they seem to flip a lot. Yeah, nothing's going on. There's no trend. And it's not you, it's not me, it's not traders, it's the entire world of traders. And even if you had $5 billion, you're looking at the data, but what they were doing was not risk on. It was, hey, we're moderate bulls, but we're not really trading. Right? We could see that. And so you need to be sensitive into the context of this. You got to look at the magnitude of 0.5 over 7 days is hardly anything. But then the real answer is start with the very long term first, which needs to incorporate fundamentals before you even do technicals. Like, why is this going up or down? And should it be going up or down? Kiwi is strong right now. Do we actually believe this, or is it a mirage? And you start there. Okay? And you get that with this point. Okay? And if you prefer the table, that's the table. And you're like, well, why should I go long pound CAD? You guys ever look at this? Look at this. We're already planning into the future. So we're bullish now, but we're going to be less bullish in the future. So once oil prices stabilize, let's say the new price of oil is $75 and it stays there, then don't be shocked in the future, meaning 6 weeks in advance, this pound CAD actually rolls over. Is it rolling over now? No. Is June a good month? Yeah. You should already know this. If you looked at pound CAD over the last 20 years, it always, right? I'll say it this way. 60% of the time, it always goes up. Right? 60% of the time, it goes up every time. We actually have better data than that, but look, it's totally normal. Totally normal for this to be going up right now. And here's the chart. It is going up. And at this rate, it's projected to continue going up. But I can also tell you that we're going to top out soon. In the next 1, 2, 3, 4 weeks, somewhere in there. And it would fall for a while. So imagine it this way. The peak is Canada Day, and then it falls at least down into the 3rd week of August. At least. Now, if I want more data, like, is it going to fall in September? Is it going to fall in October? Oh, well, that's easy. I just can't. I can't fit. I decided not to fit that on this card because if you want to do research beyond 3 months, just pull it up. Now you might say maybe we don't have it here. Okay, well then I will add these things because we do have it. I think I need a better interface if we're going to have every currency pair on the planet, but I'll do it. Okay. So I can't bring it up right now. For specifically pound Aussie, But you get the idea. I can tell you at least a drop at the sort of, let's say, around July 1st, and it's going to then likely continue to fall. We don't know if it will, but it's normal for it to fall. Not 1 week, not 3 weeks, not 5 weeks, not 7 weeks. Could be as much as 9 weeks. We don't know if it will, but it would be normal. Wouldn't you like to know this? You should know this. An institution knows this, but they have to hire an economist and an analyst and a researcher, and maybe a quant, because once you have that, then you need to know, well, what do you do with that information? And so you take all of that and they present that to a strategist who then converts that into not go long pound Aussie in the month of July and the month of August. So we do all that for you, but you don't have to spend $100,000 a month on a team. No, you don't have to spend $2,000 a month on Bloomberg Terminal, which I don't even know if it has this data, but it probably does. And now you don't even have to spend the $200 a month to unlock everything, because I'm going to launch this reward program. I want you to have this for free, which means I need to find a way for somebody to pay the bills. Maybe your broker should pay. What do you think? How'd you like all this for nothing out of pocket? The full kit caboodle, everything. Well, that's what I'm trying to do for you. All right. So what do we got going on today? Euro is strong, CAD is weak. Aussie is strong, CAD. Look at the Kiwi dropping off. This is perfect. So we love Euro, we love Aussie. Okay, yen is weak, that's great. Dollar's weak, that's great. CAD is weak, that's great. That's easy. Great. So all of this is happening right now, live in real time. So Wayne, help me put this into a trade. Okay. Anything else? Any other questions? Well, these are only very moderately decent bullish trades. These are only very moderately bearish trades. It's mediocre right now, but the stock market hasn't even opened yet. So you'll want to sit on this and watch it. Don't just look at bullish, like buy these, sell these. Dude, you can be smarter than that. Look at the change, percentage change. You might want to have your own rules of engagement. I might even want to change these rules of engagement and say, look, it's not really bullish unless it's 0.5 or more. But I don't like that, because I want you to see the trades early and then go to your charts and do your own technical analysis earlier in the trade, not after the fact, because then you would have missed the move. So these are not signals per se. Okay. Now, when you look at this point of view, not only do we have the change, but we have the conviction score. So look. After 15 calculations, bullish, bullish, bullish. There's no doubt. But look at the conviction as well. It's early. Maybe it's not too early, but it's early. So go to your charts, check them out, do your job, be a technical analyst. These are bearish, but the conviction's low. What about oil? Hardcore conviction for selling. Silver, quite bullish. Look at the conviction, 4 out of 5. Pretty good. Okay, gold, only 3 out of 5. But worth an eyeball. You see? how lovely this is. So the best opportunity right now looks like, I don't know, Euro Aussie, or I mean Euro dollar, Euro yen, something. So I like to go back to this. This is my view. I like Euro and Aussie. I want to sell CAD, dollar, and yen, right? All right. So why don't we plug that in for today's day trade? Dollar, Swissy yen. Okay. There we go. We wanted to sell. There we go. We wanted to sell some CAD. We wanted to buy some Aussie and buy some Euro, wasn't it? Okay. Let's put it in order. Now you can sit here, and once again, I would recommend watching this. But I've organized everything here for you. So here's all the pairs you're interested in trading. You didn't even have to tell Aiden if you're bullish or bearish on the pairs. It doesn't matter. He already knows. Okay. All right. Aussie CAD is your best choice right now, and it's got a modest setup. So now, if you're looking at this on your chart, this is a 15-minute chart, what would you do with a higher high, higher low scenario? Okay, so you're early, as I told you, but it looks hopeful. Euro CAD, I actually like it a little better. So I might start with that one because it's already made a higher high. We're already, right? Like, so Aiden is doing a MACD here, even though you don't see it, but he's analyzing the moving averages relative to each other. This is mediocre, so he'd be, look at neutral versus very bullish. Did you even look at this stuff? You're like, Wayne, I don't even know what this crap means. Dude, he's doing a MACD, amongst other things, to say what I just said. We're bullish, but this is, early. We're bullish, this looks better. Why? He's doing the same thing I did. I looked at him like, well, these moving averages look better. Well, a machine doesn't say, it looks better. A machine says the MACD is, right? It's math. Are the two moving averages diverging or converging? Diverging. Love it. Okay. What is this? This is the fundamentals. So what this is saying is our long-term bias was bullish, regardless of whatever you're looking at. It doesn't change very often. We're already bulls. When you analyze, trend and other parts of the chart, it is bullish. More bullish than this, even though this is about the same change, this is likely better. So anyways, dude, so I'm doing all of this for you. And you're like, they're flipping around a lot. This is confusing. Well, it's because they're all priced about the same. When the market opens and the trend takes off, it's going to stabilize. The most bullish are going to be up here. And do you need the top 6? Do you need the top 8? Or do you need the top 3? Shoot. What about the top 2? Now, you scroll to the bottom, and now you have the biggest negative numbers. What? And they're not that good. USD Swiss franc short. Okay, it is all bearish. That is a bearish trend. It is projected to fall, but it's a 0.26. That one's a 0.27. It's pound is strong. Oh, look at the pound wake up. So you're like 0.26, right? It's just negative, but you're like, okay, it's bearish and it's trending bearish. MACD is bearish, moving average is bearish. Everything's bearish. It's just not that bearish. So you can quantify that these are better opportunities in the moment. Isn't that cool? Now, what about the pound? Is it better than the euro? Oh, that's easy. Let's just do that. Let's add it. Do you see any pound trades up here? No. So it's not great yet, if at all. What about this side? Do you see any pound? Yeah. See, this is quite neutral. This is still quite neutral. Nah, pass. Isn't that cool? So you're like, okay, well, maybe I'll pass on pound right now. I'm going to pass on Kiwi. You see how lovely this is? You haven't even opened your charts yet. See, go back to your habitual ways. You habitual trader, huh? What would happen? You'd burn through your charts one after another and you'd find something to do. You know what you'd find? You'd find this. And you're like, maybe I'll trade it. Or you'll find this. Maybe I'll trade that. Nothing wrong with it. Maybe you find this. But what you're doing is you're looking for something to do, and you're not analyzing the entire global market. You're not analyzing sentiment. You're not analyzing fundamentals. It's right. And Aiden is doing this for you. So now if you just said, well, I'm going to start the morning looking at Aussie CAD, Euro CAD, Aussie Yen, Euro Yen, that'd be a good start. Just look at those four, do some technical analysis. What would you say? Definitely interested, definitely interested, definitely interested. Early, so I'm going to wait on this one. Now, once it makes a higher high, higher low, what's it going to do? Bullish. So he's already doing this for you. Don't get suckered into a mediocre trade because you're not doing the work. Now, let me provide a bitch slap, if I may, because some people respond well to it, so don't get mad at me. Okay? The old you would be the one that would just look through charts, find something to do, and do it. And you were not doing the sentiment work. You were not doing the seasonality. You were not studying the COT. You were not doing any of it. You were just looking for something to do. Well, that old you was lazy. You know to do all these things. It's just hard. It takes a lot of time. Trading is fun and exciting. It should just be profitable and boring, but whatever. So that's the old you. But now, if you're not doing this type of analysis, it's not that you're lazy. What is it? You're like, well, I have everything at my fingertips, but I still don't want to do that. I just want to throw down trades. I like Kiwi CAD. Well, quantitatively, it's not that great, but maybe later. Okay. So if you have everything at your fingertips and you still don't do it, what is the problem? And I'm being serious here. You trade because you find it fun? I thought this was your career. I thought you were going to like retire early or live like a king through retirement. I thought you want to be liberated from having a day job to being a master of your universe. I thought that's what we were doing here. You want to be a professional trader. But you can't be lazy or stupid. Right? So it's more like, dude, game on. Like, step up is what I'm saying. I'm not beating you down, trying to motivate you to step up. Like, oh my God, do you understand how unbelievably amazing this is? We're getting hours and hours and hours and hours of very complex work done for you in seconds, and you don't want to use the data? Why? It's a weird psychology issue, isn't it? So the hard part is changing our behavior. Humans are habitual. We're all habitual traders. We must strive to use this data that we have to positively impact our decision making as traders and investors, and then build new habits around that. That's when you become pro. You habitually understand what's happening now, soon, and far into the future. And you can see the changes to all of this as well so that you can adjust. Now, very, very few people can do this. Right? 5%? And the other 95% fail. So where do you stand? Are you the 5% that are willing to stand up and fight for success? Or are you the other 95%? I know where I stand. Yeah. I spent more than 12 hours on trade hours over the weekend. Much more than 12 hours. I can't get enough. I'm obsessed with success. I'm obsessed with your success. Do you want it? Are you willing to earn it? Are you willing to grow and adapt and expand? Huh? Are you willing to climb the steep hill of knowledge, the mountain of success, and stand there and say at the top, I am Groot! I am big! Because you earned it. Or is it only positive affirmations? I'm good enough. I'm smart enough. I deserve it. I'm going to drive a Lamborghini one day. Yeah, try putting 2 kids through college. Try getting 2 Ivy League degrees. Suddenly, Lambo is nothing. That's so easily achieved. You just go out and buy one. What's the problem? Raise some children, for crying out loud. There's a challenge. So I'm on your team, guys. I'm on your team. We're going to do this together. I can't make it easier. I can make it accessible. I can be here to help and lead and guide and analyze and train. You have to do the work. I can even make it more affordable. Think about it. I'm trying to get your cost of all of TradeR's unlocked, all the premium upgrades for 85% cheaper. Then I'm going to make your spread through a cash rebate cheaper. And then I'm going to make your cost of leverage cheaper. So that at the end of the day, you'll have all of this. All of this. For nothing out of pocket? My God. So I need you to fight for this, guys. I need you to fight for your success. I need you to fight to be on my team because I'm willing to fight to be on your team. Yeah, this is serious. Yeah. Don't let this go to waste. If you're not stepping up in my mind, the way that my mind works, which is maybe weird or different or creepy, but I'm like, if you don't step up, you're deciding to quit. Like it's weird. You're like, nah, really? It's like at this point, you choose success or you choose failure. Now, we don't know if you are going to succeed, but by choosing not to try, you are choosing to fail. So you choose to access success, or you choosing just to give up and fail and wimp out and play Forex like it's Fortnite. Really? This is fun for you? This is fun for you. This is fun for you? Really? Well, my arms ache, my shoulder aches, my butt aches. Sorry for the reality. My eyes are shot. My back is shot. Yeah, this isn't fun. I've been doing this for 22 years. I rarely take vacations. I rarely take weekends. This is not fun. This is my life. This should be your lifestyle. Right? Yeah, I know you're here, man. Overwhelmed. Yeah. Well, you ask great questions, keep asking. But the thing is, you have data which used to be almost unattainable for less than $2,000 a month. And if you did it on your own, much more than that, right? So, look, you have the same power and knowledge as a $1 billion investor with a giant team and massive resources in a skyscraper in some big city. You have the same now. The path has been leveled. The playing field has been leveled. You have just the same edge. Do you want to use it or not? The second thing is you need experience. And that's where AI and human coaching comes in. So Aiden and Wayne and the other coaches on our team, we have human and artificial intelligence coaching to help you learn and grow and get the experience you need. But do you want 5 years of good experience or do you want 5 years of bad experience? Do you want to go to the driving range and hit 1 million golf balls that perfect your slice? Right? Or do you want someone every single day to be there for you to give you advice and say, where are you aiming? Dude, where are you aiming? Look at your feet. And your grip, what the heck is that? Well, I keep hitting it high and to the right, so I twist the club face. And I'm like, oh my God, why don't you just hit it straight? And, because I used to do that with my club face. I would twist it so much that one day I hit a massive drive, but I hit it off the top of my driver, not even the face. I put a dent in the top of my driver because I would hit it high to the right, so I'd close the club face to the point. In this case, it was the club face was parallel to the ground. So I went to a coach and I'm like, why don't you just help me hit it properly? Instead of me keep closing the face, closing the face, closing the face. Why don't you just help me not hit it high to the right every time, right? So anyways, dude, it's hard. This is hard. But remember, this is a competitive sport. You don't have to be the smartest. You don't have to be the best. In fact, what you're supposed to do is, track what institutional investors are doing. So it's like, yeah, you might be sitting on the bench, but you're on the, you're on a NBA championship team, right? Like you're in a pretty good spot to learn. And the rest is experience. And you know me too, like I do a lot of fundamentals, I do a lot of technicals and all that kind of stuff, but I often go on tangents where we're talking about the other parts of being a trader and the other parts of, being a fund manager and the other parts of raising capital or being licensed. And we go into all kinds of things that if you want to know more about and gain from that experience, I'm here for you. Yeah. But it's a tough gig. And I addressed our conversation from Thursday of last week of, when you're here and here, why do they flip so hard? Why is it so hard to predict a swing trade? Because it just tells us, look, here's the data. I should go long Kiwi. I should go CAD. But then you're like, so I go long Kiwi and it fails. So this is useless, right? No, it's real. So then you're like, so what's the missing piece? Well, the fundamentals are likely the missing piece, but also this is the real missing piece. May 7th, +1. Negative 0.03. Negative 146. 0.26. 0.7. 1.6. Negative 358. Plus 0.92. Minus 0.74. Dude, this doesn't even really have a scale, but in this recent period, it dropped to negative 15. So for weeks and weeks and weeks, we were plus or minus 1. Well, that explains this. Oops. It doesn't matter if you switch it to swing. Hey, over the last 7 days, basically nothing has happened. There's no trend. It's very difficult to say what will be up for the next 3 weeks or down from the 3 weeks using just this. It's too simple of approach. This stuff has already happened. Now, yes, if we were trending, it's likely to continue happening. But when you go to the risk radar and look at the history, there is no trend. That is the missing piece. So you'll get better to say, okay, maybe something's changed in trend. Well, we can see that. And now your job is to say, I wonder if that will continue. So that's where you can go to fundamentals, because this is already doing all of that. But then you can go to seasonality to see if it usually continues. You can look every week at the COT and say, well, are investors following along with this new risk-on regime? Do they think it'll continue? So we can see that. And then you can start seeing maybe a new trend appear, a trend of sustained US dollar weakness, sustained Japanese yen weakness, sustained Aussie dollar strength, sustained euro strength. And that's what this is all about now. You're trying to predict the sustainability, but without trend, the relative change in price is not that important. Not for long term. It's very important for the short term. Right? Well, they're longer term. See, this is one challenge with retail traders. They're only in a trade for a day, so every freaking day they have to adjust. Okay? I've been in trades for years. Like, for example, the longest trade I've ever held was Apple. I bought it at $6 and sold it 30 years later. So if you're only short term, then you're going to get crushed during sideways periods. And I've been sharing that over and over and over again for decades. The worst period is when there's no trend. The retail traders don't seem to know this. So what happens is they make a boatload of money when there's an obvious trend. Then the trend obviously changes, but they don't adjust, and they give all the money back because they keep doing what they did 4 weeks ago. You're like, 4 weeks ago? What the hell? Okay, so they're only short term. Meanwhile, the downside to most institutional traders that I meet is they're only long term. They're like, they've been long gold even though it dropped $1,200 and they're long. You're like, well, that's not smart either, right? So what is the happy medium? Well, you need long-term and short-term. So when you recognize that there is no trend, and we have amazing tools doing hundreds of very sophisticated calculations to say, hey, bro, there's no trend. So what do? There is no swing, there is no position. You're a day trader. Because for a swing trade to work or a position trade to work, you need a trend. There is no trend. And nobody has one. So you have to say short-term short, long-term long. Now, we might be breaking out of our consolidation. Okay, now bigger institutions on hell, what they do is they say, well, during this period of the year, we're going to allocate, which means get into more positions. Okay? And then there are other periods of the year where they're like, we're not going to allocate. Maybe even take profit, rebalance, rotate, all that kind of stuff. And it's not second by second. So they would not be trading in a period when there's no trend. You see that? So this whole period when we're on the risk radar, this whole period of plus 2, -2, plus 2, -2, plus 2, -2, plus 2. You know what, Angel? They're not even trading. They're meeting with clients, they're raising money, they're doing their research, they're going to shows, they're talking at conferences. Cool. And with seasonality, you can anticipate when the consolidation occurs, and you can anticipate when the consolidation ends. Did you know we're approaching one of those periods? Cool. So when we're in here and you're looking at this every day on hell, you can say, I'm going to day trade. Day trade or no trade. When we break out into a sustained uptrend or downtrend, look, we have it all quantified. These were all negative a week ago. Now they're all positive. Okay, so if you were going to do anything, you'd be risk on. Maybe you'll get a swing. So now you look at your charts for breakouts and all that kind of stuff. But a 6 is okay. They're okay. It's okay. So you're more likely now to be able to get a swing trade than before when there was no direction. Right? But, as a hedge fund manager, for example, I would design in my contract, in my disclosure documents, and my rules for investors, I would say, you can invest at this period of time, and that's it. There's 2 times a year that you can put money into the fund. We'll open the gate here, this time of year, and we'll open the gate that second time. Also, you can request a redemption, but only in this period and that period. Because I can analyze with seasonality to say, well, I want them to exit. So let's say they redeem. They're like, give me some of my money back. Okay, you can request it here and we'll deliver it then. Let's say within 30 days, right? Now, if I were, I would structure that by looking at seasonality. If I figured they're sweating bullets and they want out, I want them to get out when prices are high, not when prices are low. And if they're begging to allocate money and get into the fund, I'm going to do it when prices are low so that they put money in, and the probability is their first, let's say, 3 months of investing is up, up, and up. And they're like, oh my God, these guys are awesome. So I build in seasonality into the gating, which is just me saying I know when to trade, know when to hold them, and when to take profit. Now, do I actually know? No, I have probabilities, and we call that seasonality, right? So we're in a period of the whole market on hold because we're at a ceasefire, a point to ceasefire in a global conflict, because globally everyone's affected. And we can see no panic, but we can also see no allocation. We're watching bonds, we're watching options, we're watching treasuries, we're watching global stock indices, we're watching futures contracts, we're watching all the currencies. And our assessment of this is there is no trend. So you're just not going to get a swing trade. No one's going to get a swing trade. And you see on hell, that's the next level. It's experience when you read the data and then you say, oh, I'm day trading this. And I'm waiting for the breakout. When's the breakout? Resolution with the war or seasonality, which is normality. So, right? Abnormality goes away and normality returns. Now you can develop a strategy. And the market's been sideways for, let's say, April and May and into June because they didn't know what's going on either with the war in Iran. Abnormality ruled the day, and we're like, well, we're bulls, but we don't really want to buy. Day trade. So now we got to watch the data and see if normality has returned. I imagine it has not, but it doesn't matter what I imagine. The other thing is, how long does a relief rally last? Because even if the Straits of Hormuz are open 100% right now, it'll take a year to get back to normal levels of supply and demand. Okay. So really nothing has changed except we can allow ships to go in and out. Cool. So the first move is just going to be a relief rally. Oh my God, pent up risk on. Buy, go away. Then reality kicks in and you're like, well, copper's still expensive because we still don't have any sulfuric acid that's required to process ore into usable copper products. And you're like, well, until we get that shipment, we can't do anything. So nothing's changed. And then, of course, now to get the sulfuric acid first, you have to pay more than anyone else has ever paid for sulfuric acid ever. So you're like, well, when do those prices come back down to normal? Well, Jiminy Cricket, could be a year. So we'll have this relief rally. Then we'll have a sort of reality retracement. Then we go into our normal seasonality. And then we have to adjust for the political elections in the United States. Okay. Yeah, so every year around this time, back when it was in FX boot camp and later investor boot camp and such, we call it shooting at rabbits. So you become heavily focused on day trading. Yes. Or fading the long-term trend. Okay. But our behavior changes because of seasonality. And we need to be able to adjust. Now, let's say that that's normal. Every year we talk about shooting at rabbits because there's no big game. And if you just focus on big game, you will starve to death. You will not make it through the summer. So we set up rabbit traps. That's normal. That's seasonal. Now, we still need to adjust. Because we might have big game this summer. We might. Things change. It's the one that adjusts. So right now, this says rabbits. Dude, look at the moose. You're like, well, I didn't bring my bow and arrow. I didn't bring my spear. I'm setting up traps. Well, dude, you better get back to the camp. Okay? And adjust your strategy. Look, there's a moose. What are you going to do about it? Well, your mama and your mama's mama and the mama for your kids is going to want to eat that moose. Yeah, well, I have. So anyways, what a wonderful day. Stock market's open. You're watching risk change in real time. This was a 6. Now it's an 8. Why? Things are changing in real time. So you can watch it here. Or you can watch it here. Or you can watch it here. And you'll never be looking at the wrong thing ever again. You'll never bet on the wrong horse again. You will never guess again. You'll never chase a mirage again. Even if you're mediocre at technical analysis, if you're trading the right asset, you have a significantly better chance of success, even if you're not the world's greatest trader. I know I'm not, but if I was trading Aussie CAD right now, at least I'm doing the right thing, and that should carry over my mediocrity into a reasonable level of success. Then I build confidence, and I keep trading the right assets at the right time, and my confidence level goes up. My consistency goes up. I consistently play the right hand at the table. Okay, you are legally and ethically counting cards. You're legally and ethically using inside information to see what institutional investors are actually doing with their money. You can actually see their trades. We looked at the yield curve on the Japanese government bonds to see exactly what they're doing with their investments and doing reverse engineering of mathematics to tell you their thought process. 54% chance of a second hike this year in December. Who cares about the one coming up? Who cares? That trade's already been done. Like, who cares? Institutional investors made those investments weeks ago, months ago, and now people on TV and YouTube want to talk about it like it's important. It's already happened. You know what a real professional would talk about? Oh my God, we're pricing out the hike in December. I need to adjust. Short run versus long run. You cannot do both in economics. You cannot do both or you cannot do one or the other in finance. You can't do one or the other in economics. You can't do one or the other in trading. You must understand both, see reality, and make the changes. You need to see the waves coming so you can plan and adjust and prepare. Did you know it's going to snow this year? It's going to snow this year. Just not this week, just not this month, not in the next 3 months, but it's going to snow. So I'm buying sweaters and jackets and ski pants on Amazon right now for super ridiculously cheap. What do? Wait until it snows and then go buy a new jacket? Really? I wonder if you got a good price. July is about buying cashmere sweaters. Do you get it? You're buying $250 sweaters for $80 because you're wicked smart and beautiful, and your fabulous skin deserves the finest cashmere. It's not cashmere, it's cashmere. So how do you live your life? I'm planning on seasonality. It's going to be cold this winter. So in July, I'm buying beautiful, beautiful sweaters. Because why waste the money? Why not be good with your money? Plan ahead. Be prepared and conquer the markets. And we can do this together, but you got to stand up and fight. I'm telling you, you got to stand up and fight. On hell is a fighter. So it'll never be easy. And even when you're great at this, it never gets easy. I'm telling you, it never gets easy. But you cannot succeed if you're blind with the facts. Boom! That just happened. See you guys, I gotta go.